Welcome back to ProcessCast with Mark Anderson and Samantha Blake. Your go-to podcast for insights into business process management and the technologies transforming the way we work.
Ever stared at your bank balance, wondering where all the money went? You're making sales, but the cash just isn't sticking around. It's a common headache, right?
Oh, definitely.
So today we're tackling that head on. What are the real, actionable ways your business can get a much firmer grip on its cash flow? We've sifted through some, serious expertise from the likes of Bain Company and Deloitte. Our aim isn't just to tell you the problems, but to give you practical strategies you can actually use, whether you're a financial whiz or, just want to understand where your money's going.
Yeah.
Our goal here is simple. Cut through the jargon, extract the most critical knowledge to help you master your business's cash flow.
Absolutely. And when we talk about successful businesses, the bedrock is, it's effective management of cash, capital, and the entire balance sheet. Bain's analysis really hammers this home. It's not just about keeping afloat. It's about actively fueling your growth, building a strong defense against economic uncertainties, and carving out a lasting competitive advantage. Think of it as the financial engine that powers everything else.
And it's not just about the dollars you have right this minute, is it? Deloitte emphasizes how vital sustainable cash flow is, especially, with the economic landscape feeling a bit unpredictable these days.
Exactly. We've all seen how quickly things can shift. Deloitte points out that there's the growing focus on really understanding and forecasting your liquidity in this global environment. It's not enough to just look at past performance. You need to be actively looking ahead, anticipating potential cash squeezes before they hit.
Okay.
What's particularly interesting is that while many companies instinctively look for external funding, new loans or investors, Deloitte's work suggests they might be missing a trick.
Oh.
Yeah, the significant capital that's often already tied up within their own balance sheets.
Huh. It's like searching for a spare battery when you haven't even checked if the current one is just loose. So what are some of the specific ways businesses might be overlooking this internal cash?
Well, according to Deloitte, if you don't have a clear, formal working capital strategy, that's basically how you manage your short-term stuff like inventory and what customers owe you.
Right, the day-to-day flow.
Exactly. If you don't have that, along with clear targets and ways to measure progress, and if these aren't communicated across the whole company, you're probably leaving cash on the table.
Ouch.
Yeah. This translates to missed opportunities for generating more free cash flow, potential cost savings, better returns for shareholders, and even just having the resources to invest in growth. It really comes down to having a solid operational and strategic handle on your cash.
Okay, so we get why this is crucial. Now let's dig into the how. What are the fundamental strategies and capabilities businesses should be concentrating on?
Both Bain and Deloitte offer a really useful framework here. First off, Bain stresses that your cash strategy needs to be tightly linked with your overall business strategy. It can't just operate in a silo.
Makes sense.
It needs to become an integral part of and actively support your broader business goals. Think of it this way. Your financial planning needs to drive and constrain where you want to go, not just tag along afterward.
That makes perfect sense. You wouldn't want your sales team pushing for rapid growth if your cash flow can't actually handle the increased need for working capital, for example. That could lead to a cash crunch even with rising revenue.
Precisely. A classic trap.
So what's the next critical step then?
Building strong cash management capabilities. Bain highlights that businesses need to develop both the knowledge and the tools to get a much clearer picture of their cash situation. This means understanding how much cash is on hand, how it's being used in different parts of the business, and how efficiently it's being deployed. It's not just seeing the numbers, it's having the insights to make informed decisions. Where should your cash be? How should it work for you?
And Deloitte adds another vital element here. The power of forecasting. They emphasize using direct cash flow forecasting and really analyzing your working capital. Things like how quickly you sell inventory, how fast customers pay you, how long you take to pay suppliers.
Those key metrics.
Right. That can give you a deep understanding of what's actually driving your cash flow day to day. This lets you predict your cash position under different scenarios like what if sales drop? What if a key supplier has trouble? And then adjust how you allocate your capital.
Exactly. And Deloitte makes it super clear. This forecasting shouldn't be just a treasury or finance department thing. It needs integration across the whole organization. You need input and understanding from people in operations, sales, procurement, everyone. So everyone understands how their actions impact the company's cash.
That sounds like it could be transformative, getting everyone thinking about cash flow. But how do you actually make that happen in a real business? That seems like a big cultural shift.
It is, and Deloitte emphasizes the role of governance as foundational. You need a strong framework, active involvement from all the key people, open communication, collaboration across teams, and clear alignment on goals.
Right.
They even point out that strong governance around, say, short-term forecasting can really push functional leaders to consider the cash flow consequences of every operational decision they make.
So it's about making cash flow a shared responsibility, not just dumping it on the finance folks. What else is crucial for building this kind of foundation?
Setting clear goals right from the start is key, according to Deloitte. This empowers those functional leaders we just mentioned to then streamline their own processes to optimize liquidity.
Okay, it gives them something concrete to aim for.
Exactly. They also highlight having a regular schedule, a cadence for discussing a central forecasting tool. This creates accountability. It provides a space to really understand the end-to-end issues affecting cash conversion.
Yeah.
Where are the bottlenecks? What's slowing things down? Functional buy-in is crucial here.
So regular check-ins, shared data. That makes sense. And what happens when your actual cash flow doesn't match what you predicted? Because, let's face it, forecasts are rarely perfect.
No, they aren't. And that's where transparency and thorough analysis come in. Deloitte stresses understanding both what the differences are and why they occurred. Was it just a bad assumption in your forecast, or is there a deeper process issue?
Mm-hmm.
This analysis is essential for continuous improvement. And linking back to resilience, Deloitte highlights building different liquidity scenarios, wargaming your finances, essentially.
Right.
By understanding potential impacts, good and bad, you gain confidence and can make faster, better decisions when surprises hit.
Precisely. And to make all this stick long term, Deloitte says invest in that fundamental governance structure first.
Yes, build that strong foundation. Then your forecasting and management become much more reliable and insightful over time.
This is all about building a robust system, not just reacting. Now, we've talked structure, process. What about the people side? How do you get everyone in the company to actually care about cash flow?
That's where cultivating a strong cash management culture comes in. Deloitte has some really important insights here, and it absolutely has to start at the top.
Leadership buy-in, always key.
Always. Senior management needs to visibly prioritize cash flows, consistently encourage financial discipline, and not just when times are tough, but in good times too.
Yeah.
It can't be a crisis-only focus.
Agreed. Sets the tone. But how do you translate that high-level priority into, concrete actions across different departments?
Deloitte suggests embedding this culture by clearly defining cash flow objectives, assigning responsibility across the organization, not just finance, and then actively tracking progress with, say, monthly cash flow metrics. Transparency is key. They also stress establishing, communicating, and implementing standard policies. Budgeting, forecasting, financing, covering day-to-day stuff like collections and payments.
So clear rules of engagement, everyone knows their part.
Exactly. And Deloitte makes a crucial point. Cash flow management is an operational issue, not just financial. Sales, marketing, procurement, production, every department impacts it and needs to coordinate.
Right.
To really drive this home, some companies even link part of staff compensation to hitting cash flow targets.
Whoa, okay. That would definitely get attention.
It certainly would.
They're moving beyond culture and strategy. What are some specific practical best practices businesses can adopt, right now, to see tangible improvements?
Okay, several really concrete steps here, and Deloitte outlines some effective ones. One key area is leveraging technology to speed up your cash conversion cycle. Turning spending back into cash faster.
Like using software?
Yeah, using electronic invoicing, vendor portals that can significantly speed up billing and collections. Plus, you get much better, more timely reporting. Helps you follow up on late payments faster or maybe grab early payment discounts from suppliers.
So moving away from paper, embracing digital, makes sense. What's another practical step?
Optimizing your core financial functions is a big win. For accounts receivable money customers owe you, it means reducing invoice errors, because errors always cause delays.
Always.
And having a regular system for following up on outstanding invoices. On the accounts payable side money you owe, it's about negotiating better payment terms, maybe rebates, using purchased orders to control spending, getting volume discounts, and regularly benchmarking your vendor contracts.
Smart. Being efficient and strategic on both ends, getting paid fast, managing outflows well, but, keeping good relationships.
Precisely. And inventory optimization is another critical one Deloitte highlights. Regularly analyze profitability by account, by product. Identify and reduce slow-moving or obsolete inventory. This stuff just ties up cash.
Dead weight.
Totally. They also say consider cash flow implications of supply chain changes, like sourcing from cheaper countries might cut unit costs, but maybe it needs bigger upfront payments or longer shipping times, hitting your cash flow negatively. It's a trade-off.
So the lowest cost on paper isn't always best for cash flow. It's more complex.
Exactly. And then there's the absolutely crucial aspect of cash flow reporting visibility. Deloitte emphasizes actively tracking cash flows through regular, accurate forecasting.
Okay.
This means linking your income statement and cash flow statement to those key working capital metrics on the balance sheet, DIO, DSO, DPO. How long inventory sits, how fast customers pay, how long you take to pay suppliers.
Those core cycle times.
Right. And include capital spending, debt repayments in your forecasts for a complete picture. Automate forecasting if you can, saves time, reduces errors, and then actively review variances, actual versus forecast, to refine assumptions. Deloitte even suggests being ready for weekly forecasting in tight times, maybe even a cash committee.
Wow, weekly. That level of scrutiny sounds intense, but probably necessary when things get tight.
Absolutely. And then there's the fundamental principle. Match your funding timing to your obligation timing.
Meaning?
Deloitte explains. Align short-term funding with operational expenses and long-term funding loans, equity with capital projects and debt maturities. Helps ensure you have cash when needed without extra cost or risk.
Right. Kind of financing for the right purpose and time frame.
Precisely. Finally, Deloitte stresses an enterprise-wide perspective. If you have multiple locations or departments, track cash sources and uses by type, by location. Involve all relevant functions, sales, procurement, ops.
Get everyone involved.
Yeah. Get that holistic view. Identify trapped cash, benchmark internally and externally, align capital plans with funding. They even suggest, again, maybe linking working capital performance to compensation.
So it really isn't just finance. It's how the entire business operates and thinks about cash. Now, we've discussed general best practices, but what happens when things take a turn for the worse? We all remember the shockwaves from COVID-19. What key lessons did that teach businesses about managing cash flow during a crisis?
Oh, COVID-19 really brought the critical importance of proactive cash flow management into sharp focus. Deloitte's analysis on navigating that crisis was insightful. The immediate takeaway: you absolutely need a comprehensive treasury plan for cash management right from the start as part of overall risk and continuity planning.
Not an afterthought.
Definitely not. And, as they emphasized earlier, take a full ecosystem view. Consider your whole supply chain. Your actions impact customers and suppliers too.
Absolutely. It was a stark reminder of how interconnected everything is. What were some specific actionable strategies Deloitte recommended during that intense uncertainty?
One crucial area was proactive supply chain risk management. Businesses needed to really understand the financial stability of key partners, customers, and suppliers to anticipate payment issues or disruptions. They also strongly emphasized ensuring your own access to financing remains secure. Couldn't just assume credit lines would be there. So running scenarios for cash needs, proactively talking to banks, confirming lines, exploring options, absolutely critical.
Preparing for the worst case, having backup plans.
Exactly. And Deloitte highlighted a big shift. Focus less just on the income statement, more on the balance sheet, specifically the cash-to-cash cycle.
Right. Payables, receivables, inventory.
Yes. Actively manage those in a coordinated way to minimize working capital needs.
Yeah.
They also stressed fostering a CFO mindset everywhere. Encourage everyone, regardless of department, to consider financial constraints in their decisions.
That's a pretty significant cultural shift. What about immediate steps to just conserve cash quickly?
Revisiting all variable costs was key for quick wins. Travel bans, less discretionary spending, hiring freezes, reducing contract labor.
The usual suspects.
Right. Also, encouraging employees to take accrued leave, reducing that liability. For capital investment, scrutinize what's essential short-term. Postpone or reconsider non-essential stuff, but still identify crucial investments for the eventual rebound.
So, tight control, but don't kill the future. What about managing goods and payments?
Inventory management got even trickier. Update safety stocks for volatility, consider strategic reserves, manage finished goods closely, especially perishables. On payables, extend terms, intelligently work with suppliers on agreeable terms. Don't just delay unilaterally. Maybe even accelerate payments for critical distressed suppliers to protect the chain.
Interesting. Supporting key suppliers.
Yeah. For receivables, intensify collection efforts, monitor customer payments closely, ensure accurate invoicing to get cash in faster.
It sounds like a very delicate balancing act, shoring up your own cash while being mindful of partners' health.
Absolutely. And they also suggested exploring alternative financing, like factoring receivables or dynamic discounting, though weigh the costs. Auditing payables and receivables for accuracy, leveraging discounts became even more vital. Maybe use automation here.
Yeah.
Deloitte also strongly advised understanding your business interruption insurance, what's actually covered.
Good point. Often overlooked.
It is. And think creatively. Alternate revenue streams. Convert fixed costs to variable where possible, like leasebacks or contract manufacturing for flexibility.
Thinking outside the box.
Exactly. And finally, crucially, think beyond your four walls. Consider the ecosystem impact of your cash actions. Do financial risk checks on critical suppliers. Be ready for deeper interventions if needed to keep essentials flowing.
So in a crisis, have a plan, be adaptable, focus intensely on cash, and consider the ripple effects. It sounds like many of these crisis lessons are just sound business practices anyway, just amplified.
That's precisely the key insight. Effective cash flow management isn't just about surviving tough times. It's about building a robust, resilient foundation for sustainable growth and long-term success, whatever the economic weather.
So we've covered a tremendous amount today. Why cash flow management is essential, core strategies, practical best practices, crisis lessons. As we wrap up, what's the single most important takeaway or final thought for our listeners?
Consider this. What is the one most impactful action you can realistically take right now, maybe even today, to get better visibility or more control over your business's cash flow? It doesn't have to be huge. Even just starting a simple weekly review of receivables or building a basic cash forecast. Those small steps can lead to significant positive changes in financial health and strategic agility over time.
That's a really powerful point. Sometimes the biggest transformations start small. Well, if you found this useful and want to explore more, remember the kinds of expert resources we discussed. Consulting services, industry articles, research reports, they're out there. Proactive cash flow management isn't just about survival. It's about empowering your business to truly thrive.
Thank you for listening to ProcessCast. This episode was brought to you by HEFLO, the BPM platform that empowers businesses to document, automate, and optimize their processes with AI. Experience the intelligence to simplify complex business processes and accelerate your growth with our complete management solution. Visit heflo.com to learn more. Be sure to follow ProcessCast for more insights on business process management, and don't forget to share this episode with your network. Until next time.